It's just been released in public filings that Warren Buffett sold all of Berkshire Hathaway's S&P 500 holdings. And frankly, this has me more than a little bit worried. So let's jump in and see what's going on. This article here is by The Motley Fool. It's titled, "Does Warren Buffett Know Something That Wall Street Does Not?" He sold a Vanguard index fund that analysts say could soar over 100%. Okay, the article goes on to say, last week, Warren Buffett's Berkshire Hathaway submitted its Form 13F for the fourth quarter. That document detailed several changes to its portfolio, including the fact that Berkshire sold a stake in its S&P 500 ETF. The article goes on to say, despite optimistic forecasts, Warren Buffett sold Berkshire Hathaway's entire stake in the Vanguard S&P 500 index during the fourth quarter. In fact, he sold the only two index funds in Berkshire's portfolio, and both were S&P 500 index funds initially purchased in the fourth quarter of 2019. Okay, so what is this 13F? According to Investopedia, I want you to know what it is. According to Investopedia, the 13F is a quarterly report that's required to be filed by all institutional investment managers with at least $100 million in assets under management. So it gives us a peek into what Warren Buffett's doing. And I love the fact that investment managers are required to issue this report. It's a quarterly report, and this is the latest one from Berkshire Hathaway, but it gives us some insight into what these institutional managers own and what they've decided to sell. And it could be a heads up for us. So I want to go to another article, and then I'll share what it means to all of us and what I think we should do based on this. But first, I want to go to another Motley Fool article where it says Warren Buffett sends a dire $134 billion warning to Wall Street, and history says the stock market will do this next. So this is important. So in this article, they're going to share with us what happens when Berkshire Hathaway is a net seller of stocks. So they sell more stocks than they buy more stocks. I think you're going to find it really interesting. And the article says, history says the S&P 500 will have a below average year in 2025 based on what Berkshire has done in the past and then what in the following year has happened to the S&P 500. So the author wrote a chart, and I should mention that this article just came out as I record this, just a couple days ago. So the chart below lists 7 years in which Berkshire was a net seller of stocks. It also details how the S&P 500 performed in the next year. For instance, as shown in the first row, Berkshire sold more stock than it purchased in 2010, and the S&P 500 returned 0% the following year in 2011. So let's look at this chart. So the author walked us through the first year, 2010. Berkshire was a net seller. They sold more stocks than they bought, and the S&P 500 was flat that year. So that's not a good sign. But again, there's 7 years we're going to go through. So let's do the next one. 2012, Berkshire was a net seller of stocks. But in 2013, the S&P 500 was up 30%, 30%. So it's not always an indicator. Let's keep going. In 2014, Berkshire was a net seller of stocks, and the market was essentially flat. It was down 1%. 2016, Berkshire was a net seller. The next year, the market did 19%. I'd take 19%. 2020, Berkshire was a net seller and the market was up 27%. We all remember what was going on. That was a very unusual year. That was the year the pandemic started, obviously. 2021, Berkshire was a net seller, and the following year, 2022, was a negative year for the S&P 500. It was down 19%. 2023, Berkshire was a net seller. In the following year, 2024, the S&P 500 was up 23%, and the average of all those is 11%. So what does this mean for you and I? So just because Berkshire is selling a lot of stock, it doesn't necessarily mean that the market's going to do poorly. In fact, That averages out to be 11%. Would I take 11% as an average for my equity investments? You better believe I would. So it's not necessarily a warning sign. And I think we need to go back to our fundamentals. First off, the fact he sold the S&P 500, unless he's got another investment coming right behind it, the S&P 500 could be a nice way to park some money while you're waiting to do your next major acquisition. So if Warren is selling this stock in order to raise money because he knows he's got an acquisition potential on the horizon, and at the size of Berkshire, he's got to buy a really large company. If that's the case, it's not a signal at all. It's just Warren managing his money, Berkshire Hathaway managing their money the way that they should. They need to raise cash for this potential acquisition. None of us know. In time, we will find out whether there's a potential acquisition there. But if Warren is selling in order to reduce his exposure to equities, the nice thing about the S&P 500, for a big company like Berkshire, they can sell that position and likely not move the price of the ETF. So for a smaller ETF, if somebody was selling the amount that Warren Buffett is selling, they might actually move the price negatively by them selling, by them dumping that stock or ETF. It could lower the price. So the nice thing about the S&P 500 is there's enough trading in that it's unlikely it's called working the trade. They probably work the trade over a period of time. But for you and I, it really comes down to it's time in the market, not trying to time the market, and getting our asset allocation right. Those are the two main things. And I guess I would add a third one, which is avoid being a forced seller in a down market. Okay, so let's talk about each of those. Time in the market, not timing the market. Over time, the stock market tends to go from lower left to upper right. And that's a good thing if we can stay the course. The challenge is, of course, it doesn't go in a straight line. The saying in my industry is it takes the stairs up and it takes the elevator down. So it tends to go down very quickly. So we need to be able to stay the course when the market makes these corrections along the way. So that's why time in the market. If we try to time the market as opposed to spending time in the market, having a long-term allocation, we're much more likely to underperform. So that's the first one. The second one is asset allocation is key. We need to be able to withstand those downturns in the market. And unfortunately, as we get older, and particularly once we retire, then the pain of those losses becomes much greater than what it was when we were working and we had new money coming in. Because now, instead of having new money coming in, when we had new money coming in and the market went down, we could be buyers. But the people we were buying from were people that may have been forced sellers in a down market. So I don't want you to be that forced seller. And one of the ways retirees become forced sellers in the down market is either they need the money or the mental pain that they're going through because of the downturn in the market is just too great. It causes angst and they blow out of the market. And unfortunately, that angst, that pain increases as we get older. Another thing that changes is just how we look at life and how we think about our future and the prospects and how long it took us. Let's say the market drops $100,000 in your portfolio decreases by $100,000. That can be really painful for you. So if you found this video helpful, YouTube says you'll like this video next. Thanks for watching this one. Bye-bye.